In this video, I'm going to show you how to win the business of a high-quality borrower even when your offer isn't their cheapest option. I'm Chris Nichilo, aka The Wealthy Lender, and the founder of Magnetic Capital Group, Canada's premier private mortgage investment services provider. Since 2019, I've helped other people lend over $110 million in private mortgages secured against residential properties. Now, during that time, we've successfully exited hundreds of loans without experiencing a single investor loss. We've navigated challenging economic times, from the uncertainties of COVID-19 to soaring inflation and rising interest rates. And we've emerged with a model that's not only viable, but also sustainable and safe for investors. In other words, we've built a very sturdy ship that's weathered many storms, and our proven track record shows that we know how to steer through rough waters. A big part of our secret is our ability to identify high-quality opportunities and then structure offers to those borrowers that make them want to choose us as their lender, even if we aren't the cheapest option. Our experience tells us that about 5 of every 10 applications we see are not even worth spending more than a few minutes considering. They're applications from desperate borrowers who need to sell their property, but just haven't come to accept that fact yet. Of the remaining 5, though, 1 or 2 will be such high quality that every private lender who sees them will want to make an offer. And the other 2 or 3 are opportunities for us to create a win-win solution for a borrower if we just apply a little creativity. So whether you're a seasoned lender or just starting out, your goal is to craft offers that are competitive, sustainable for the borrower, and well aligned with your risk tolerance. But you also have to compete for the business you want. And you can compete on price, or you can compete on value, but you can also compete on both. Here's the good news. All private mortgages come with a premium. They're inherently more expensive than traditional loans. So it's okay to price your loans a little cheaper when you need to, and have more of your money lent out more often. But you don't always have to be the cheapest money to win a borrower's business. Imagine walking into a restaurant where every chef offers the same dish at different prices. One chef might not be the cheapest, but if they offer a little extra sauce on the side or a personalized dining experience, you may be willing to pay a bit more. In private mortgage lending, that extra sauce could be creative value adds that make your deal more attractive without slashing your returns. A common mistake for new private mortgage lenders, though, is the temptation to overcharge borrowers simply because you can. Picture a street vendor at a busy market who raises his prices sharply just because he recognizes that all the other vendors are out of food and he's the only remaining option for hungry shoppers. At first, it might seem like a great idea to make extra profit from desperate buyers. But if customers feel forced into an overpriced purchase, they quickly realize they're being taken advantage of, and they won't soon forget. In our industry, taking advantage of borrowers can backfire if our terms aren't sustainable. That'll lead to defaults, which is the last thing you want. Now, for an example, consider a scenario where a borrower accepts a high rate because they believe it's their only option. Over time, the burden of that rate can stretch their finances too thin, much like buying an expensive gadget on credit and then struggling with the monthly payments. In both cases, the short-term gain for the lender or the seller turns into long-term problems. Instead, aim for pricing that respects the borrower's capacity while ensuring that you earn a reliable return. It's a balancing act, much like seasoning a dish. You want just that right amount of spice so that it's flavorful without being overpowering. Now, before you set your pricing, though, it's crucial to plan how the loan will eventually be repaid. Think of it like planning a road trip. You wouldn't start your journey without a clear destination in mind and at least have a backup route in case you hit traffic. With private mortgages, the borrower's exit strategy, whether through refinancing or selling the property, is your roadmap to success. And while refinancing can be uncertain, the property sale is something you can evaluate in advance. Consider a property valued at $500,000. If you're willing to lend up to 80% of its value, you're looking at a maximum loan of $400,000. But before even considering the borrower's income or credit score, ask yourself this: if this property were to be sold, would the proceeds after commissions and legal fees comfortably cover that $400,000? If the answer is yes, then you can move on to the borrower's details. If not, it's best to just walk away early, just as you wouldn't embark on a road trip without ensuring you have enough fuel to reach your destination. Now let's talk about due diligence on the borrower. Running these checks is much like doing a pre-purchase inspection when you buy a used car. You wouldn't just rely on the seller's word that the car runs fine. You would check the engine, inspect the tires, run a history report. Similarly, you need to evaluate the borrower's income, credit history, and tax records to ensure they have a reliable track record of meeting their financial obligations. Trust your gut, run the numbers, and we can make sure that the borrower can realistically manage the loan payments. Once you've done this, you'll have a good sense for the overall risk level of this loan compared to other applications you fund or decline, and that's a good place to be when you move to the stage of crafting your best offer. Hey, if you're finding this content valuable, I want to invite you to join my free school community. There, I walk you through the entire process of becoming a successful private mortgage lender, from identifying the right borrowers to pricing your loans competitively. Our community offers comprehensive modules, tools, and weekly Q&A sessions where I personally answer your questions. To join the community, just click the link in the description below. Once you're confident in both the exit strategy and the borrower's ability to pay, it's time to set your pricing. Now, as a general rule of thumb, it's a good idea to establish a pricing range for all your loans. For the most part, I price all my loans within a 2% range. For first position mortgages, a range of about 7.5% to 9.5% is a good target. And you might adjust that range by as much as 1% either way based on the current economic climate. For second mortgages, consider a range of about 10 to 12%. Now, this range is like having a menu with different spice levels. You can have a baseline, but you can also adjust based on the heat of the economic environment. The LTV ratio is a key lever in your pricing strategy. It's important to set your upper LTV limit, and I suggest not going higher than 80%. That's the limit our banks in Canada set for a conventional loan. Anything higher than that requires insurance, which tells you a lot about where banks feel the risk is. Now, if I'm lending money at my upper LTV limit of 80%, that loan is likely going to be priced at the highest end of my range. Imagine a borrower needing $400,000 on a $500,000 property. At 80% LTV, I might charge 9.5%. Then, for every 5% decrease in the LTV, say moving from lending 80% of the value down to 75%, I might reduce the rate by half a point to 9%. And again, down further a half a point again to 8.5% if I'm lending 70% of the value, and so on. My cheapest rate might go to someone seeking 65% or less of the value of their home. The point is, I might offer a discount as my risk comes down. The lower the percentage of the property I'm financing, the better rate I might offer. Now, if you ever find yourself tempted to charge beyond the upper limit of your range, say more than 9.5% for a first mortgage or over 12% for a second, consider it a red flag. Risk is entirely subjective, so if it feels like you need to charge higher than your upper limit, the risk is probably too high for you to feel comfortable, and you should move on to another application. Now let's address the misconception that you always have to be the cheapest to win the deal. In competitive markets, borrowers, especially those with strong profiles, often have multiple lenders vying for their business. They're like savvy shoppers in a car dealership who aren't just looking for the lowest sticker price, they're also looking at factors like warranty, service packages, and extra features. So here's how you can differentiate your offer without undercutting your return. Imagine offering an interest reserve on the loan, a sum of money set aside to cover some of the monthly interest payments. This is like a car dealer offering a free maintenance package for the first year. It eases the borrower's monthly burden, making the payment more manageable without reducing your fee. You can also reduce prepayment penalties. It's another way to add value. Think of it as offering a flexible return policy in a retail store. Most lenders will charge the borrower 3 months of interest as a penalty if they pay the loan back earlier than expected. If you were to reduce this charge to 1 or 2 months, this could be very valuable savings for a borrower who anticipates paying the loan back quickly. And I can tell you from experience that most borrowers believe they're going to pay their loans off sooner than they actually do. Borrowers perceive a lot of value in the freedom to pay off their loan early without incurring heavy fees, which can be a decisive factor when they're comparing their offers. You could also offer cashback incentives at maturity for timely repayment. That's like offering a rewards program on a credit card, and it provides incentive to the borrower to meet their obligation to pay you back on time. Imagine offering to waive your $500 discharge fee if they pay the loan off in full on time. Or perhaps you might offer to give them $500 cash back towards their appraisal if they choose you as their lender. These types of levers build loyalty, and they show that you value a successful relationship and a partnership. Incentives like these can tip the scales in your favor, especially with high-quality borrowers who are considering multiple options. They're creative, and they serve as unique value adds that make your offer stand out. Instead of competing solely on price, you're offering a complete solution that addresses the borrower's overall financial comfort, a win-win situation. Over time, establishing yourself as a fair, transparent lender who adds genuine value, that'll naturally attract higher quality applications from borrowers and the broker community. You just think of it like a popular restaurant that builds a loyal following. When people know they can expect not just good food, but also a great dining experience, they keep coming back, even if the prices aren't the absolute lowest in town. Quality applications matter. It might take sifting through several offers before you find that one borrower with a rock-solid exit strategy and strong financials. So the key is generating a consistent flow of quality applications to go through. And the best way to do that is by becoming known in your area as an honest lender. Ultimately, building your private lending business this way will lead to a healthier portfolio, improved annual yields, and most importantly, fewer defaults. Consider the long-term benefits. A strong reputation means brokers and borrowers will come to you first. Your pipeline of quality deals will grow, and you'll find that your capital is working harder and longer. Much like a trusted brand in any industry, once you build credibility, referrals and repeat business become a natural outcome. And it's a virtuous cycle. Better reputation leads to better deals, which in turn reinforces your reputation. So let's summarize the 5 key areas that I've covered today. Number 1, price with purpose. Craft your loan offers according to risk. Make sure your terms are competitive and sustainable based on the borrower's ability to pay. And avoid the temptation to overcharge, even when the opportunity seems ripe, because a fair rate ultimately protects both parties. Number 2, ensure the viability of the exit strategy. Always start with the end in mind. Evaluate the property first, much like planning a road trip with a clear destination and a backup plan. Only proceed if the property's sale can feasibly cover the loan. Number 3, know your client. Think of conducting due diligence on the borrower's financial circumstances like a pre-purchase car inspection, ensuring that the borrower can likely meet their obligations. Number 4, find creative ways to add value to optimize your returns while minimizing risk. Remember, you don't have to be the cheapest option. Just use creative strategies like interest reserves, flexible terms, and cashback incentives to add real value. And last but not least, number 5, build a strong reputation. Over time, a reputation as a fair and value-driven lender will naturally attract higher quality borrowers and brokers. This means more choices, a healthier portfolio, and ultimately better returns with fewer defaults. By following these principles, you position yourself to not only secure better deals, but also cultivate long-term relationships that benefit both your bottom line and your borrower's financial well-being. So, thanks for watching. If you enjoyed this video, please give it a thumbs up, subscribe, and hit that notification bell so you never miss an update on private mortgage lending insights. Drop your questions or suggestions for future topics in the comments below. And remember, empowering yourself with knowledge is the key to achieving great results in the private mortgage investing space. So, until next time, happy lending.